Hello everyone and welcome back to the Modern Investing channel. Last week Alibaba reported earnings and there are a lot of hidden gems in there. In this video we take apart the balance sheet to dig into what was good, what was bad, to understand the business at the deep level, and then we will run a discounted cash flow analysis to find the intrinsic value of the stock and determine at what price Alibaba is a good buy. If you get value out of the video, please click the like and consider subscribing. It really helps a lot the channel if you do so. Thank you. Without further ado, let's dive into it. Alibaba is a Chinese tech giant, and for understanding the fundamental of the business, you can check out this previous video I made not a long time ago. Last week, Alibaba reported Q1 earnings, and the update revenue pie is that 87% of the revenues are accounted in the core commerce business. 8% is in cloud computing and 4% in digital media and entertainment. So also as of this quarter, core commerce is still the absolute dominant part of the business. If we look at the growth of these three sectors as compared to the same quarter a year ago, we can see that the core commerce grew the most, with a solid 35% growth. This was in line with expectations. What raised eyebrows was the cloud computing segment, which grew quote unquote only 29%. In China, in the past year, cloud computing grew at 50% as an industry, and this means that Alibaba has underperformed its competitors. A big reason for this is that the company holding TikTok was a huge customer of Alibaba and it pulled out this quarter. The reason is that it will have to look for a US cloud computing counterpart in order to comply with US regulations. It is unfortunate, but that's part of running a business, and otherwise the sector is growing strongly. Then we have the digital media and entertainment space, which grew 15% as compared to a year ago, which was also in line with expectations. Annual consumers and monthly mobile active users are growing steadily. Very nice to see, signaling a healthy growing business that is attracting new customers. If we look at earnings expressed as adjusted EBITDA, we can see that they improved in all segments this quarter as compared to the same quarter last year. Core commerce is growing, cloud computing is turning profitable, and digital media entertainment is decreasing the losses. So a positive outlook from this perspective. So we see a lot of growth in all segments, but the big question is Alibaba able to convert effectively all the new revenue money into actual earnings? I made this exercise to find it out. I dug into the income statement of the last years and I found something very interesting. Here I have included important points of the income statement with the latest numbers expressed as a trailing 12-month. Revenue has been growing like a beast, with an impressive compounded annualized growth rate from 2016 to the recent trailing 12 month of 47%. We can see that in all periods apart from 2019, revenue increased more than 40% year over year. Truly amazing growth. When we look at free cash flow, which is what we care as investors because it's how much money the company made after paying for all costs, we can see that the free cash flow grew also very strongly with a compounded annualized growth rate in the same period of 32%. However, we can notice that it is less than the revenue growth. So I wanted to dig it deeper and understand why free cash flow grew slower as compared to revenue over the years. Free cash flow is negatively affected by the company expenses, of course, and capex is a big factor because it accounts for the purchase of buildings and equipment. We can see that in the same period, capex only grew at a 25% pace, meaning that no, capex is not to blame. Let's now look at operating expenses, which includes salaries, maintenance, marketing costs, and ongoing costs. Here we can see that we found the culprit. They increased at a compounded 56% growth, which is higher than the revenue growth, and it is likely the reason why free cash flow grew slower. When we dig even deeper and we look at the cost of revenue, which is the total cost of manufacturing and delivering a product or service to consumer, we can see that it grew even faster. So we found the reason why Alibaba revenue grew at a 40+% rate, but free cash flow only grew at a 30% plus rate, because the operating expenses, and in particularly the cost of revenues, increased sharply over the years. This exercise is important if we want, as investors, to understand the business at a profound level. I read the quarterly report, and Alibaba claims that it is investing heavily in the direct to consumer business, like SunArt, which is a supermarket chain. Such businesses have a much higher expenses and hence why the cost of revenue of Alibaba increased dramatically. If we look at it at a higher perspective though, it is a positive in my opinion that Alibaba diversifies into many sectors. And SunArt, for example, opens the possibility to purchase something online and pick it up at a physical shop. Overall, it is annoying that in the short term Alibaba expenses are going up and therefore margins are coming down. But as Alibaba continues to grow at a staggering pace, it is a good insurance policy for the business to diversify and in the long term find synergies in the different segments. Another expense that drew up operating cost is marketing expenses. Alibaba claims that the increase in spending is drawing more user acquisition and engagement in the marketplaces, as well as it helps growth initiatives in general. The way I stand is that I am a long term investor, so in my opinion, this short term pain is welcome if it allows for user growth and for building an even stronger moat. So, if we zoom in and look at the data of this last quarter alone, the good news is that the company is still growing at an extremely fast rate despite its huge size. 30 plus percent revenue growth in the last quarter. Fundamentals are still strong, and within the core commerce, the segment international is growing the fastest, with a plus 54% revenue growth. This is a small part of Alibaba revenue pie, only 5% of it, but it has a huge potential. And in this, Lazada, which is an e-commerce platform in the Southeast Asian countries, recorded over 90% year-over-year order growth. Quite amazing. Also, Alibaba announced that it is boosting its share buyback program by 50% to $15 billion. That's quite a lot of money that is returning to shareholders and will decrease the total share count by almost 3%. Finally, cloud computing turning profitable, which is great to see. The bad news of this quarter is that Alibaba is suffering an increased cost of revenues, and this is mainly due to an increase in the direct sales and inventory costs due to the endeavor in SunArt. As I mentioned earlier, this adventure strengthens Alibaba direct-to-consumer commerce segment and expands in that market, which is good, but it comes at the expenses of margins and specifically cost of revenues. Alibaba also increased sales and marketing expenses, which are primarily for marketing in growth initiatives as well as user acquisitions and engagements. All these increased costs hurt the net income that decreased 8% year over year in the last quarter, as well as free cash flow that decreased 43% year over year in the last quarter. This was due to an aggressive increase in investments that we just talked about and the partial settlement of the anti-monopoly fine. Based on this information, at what price is Alibaba a good buy? I drew some numbers to predict Alibaba growth over the next years, which we will use in the discounted cash flow valuation, allowing us to draw the intrinsic value of Alibaba stock. For the core commerce, we know that Alibaba is the dominant Chinese player with 60+% market share. And we also know that the Chinese e-commerce market grew at 18% compounded annualized growth rate in 2016 through 2020. And we also know that the market is forecast to grow at 14% in the next 5 years. Alibaba's Chinese retail e-commerce grew in line with the market at 14% growth year over year. I expect that the Chinese retail e-commerce to keep on growing in line with the market at 14% growth. I expect the international business, the direct sale business, and the logistics service, which are receiving a huge investment by Alibaba, to grow much faster, at 50% in the next 5 years and 25% in the 5 subsequent years. For cloud, we know that Alibaba is the dominant Chinese player with 40% market share. Also, we know that the Chinese market grew at 61% compounded annualized growth rate in 2016 through 2020 and 50% in the last year. The market is in the next 5 years expected to grow at 25 to 29%. Alibaba grew less than the market year over year in this last quarter at 29% growth. I expect that Alibaba cloud segment to keep on growing with the market, and I predict an average 26% growth in the next 5 years and 15% growth in the 5 subsequent years. Putting my predictions of revenue down in a model, I have predicted that the customer management business, which is the core commerce, to keep on growing at 14% for the next 10 years, and the same growth rates go to the Chinese commerce wholesale, the local consumer services, which is primarily the food delivery business, and others. Then there are some categories which I predicted to be hyper growth in the coming 5 years, where I assigned a 50% growth. These are the categories where Alibaba is currently investing billions and billions of dollars in marketing, user acquisitions, and straight purchasing of other businesses. Which are the others category here, which is the direct to consumer supermarket business, the international commerce retail and wholesale, as well the logistics service. I think this will do fantastic in the coming years, and afterwards in year 5 to 10, I predicted the growth to drop to 25%. Furthermore, the cloud computing business, I have it growing at 26%, in line with the market in the next 5 years, and then to 15% in year 5 through 10. Digital media and entertainment and innovation initiatives are difficult to predict, so I prefer to keep a conservative growth estimate of 5% in the next 10 years. If we make a sum of revenues that these businesses will produce in the coming years in this model, we can see that they will be growing at a compounded annualized growth rate of 31% in the next 5 years and 21% thereafter. If we compare these numbers with Alibaba's average growth in free cash flow in the last 4 years, we can see that the growth rates are pretty similar, around 30%, which makes me think that these growth rates are quite realistic. In the discounted cash flow model, I will therefore input 31% growth rate for the next 5 years and 21% for the 5 subsequent years. So here we are with Alibaba's discounted cash flow model. We have the growth rates up here, the discount rate, which is the weighted average cost of capital of 8%. Then we have the terminal free cash flow multiple of 24.8 to calculate the terminal value. I reached this number by averaging the free cash flow multiple of Alibaba from 2015 to today, the total current assets and liabilities, and the share outstandings. All these numbers are in millions. In the model, I put a starting free cash flow, which is the average of the last 3 periods, $30,648 million. All the future cash flows are in this row, and the discounted ones are in the row below. This gives us an intrinsic value of the business of approximately 3.7 trillions, which corrected for debt and divided by the share outstandings gives us a present fair value of the stock of $1,388. The stock trades today well below this price at around $200, and it is therefore, based on this model, extremely undervalued. It needs to grow at almost 7x to reach its intrinsic fair value. This is of course assuming that the management succeeds in printing these growth numbers over the years and the market will value the stock in 2030 at 24.8 multiples the free cash flow of 2029. The sentiment around the stock is terrible, and it is now trading at prices that it was trading 3 years ago, despite the business itself has been growing massively ever since. I believe that eventually the Chinese stock negative news cycle will fade away and the stock will catch up with the fundamental of the business. In conclusion, Alibaba is still growing strong in core commerce and the cloud business has turned profitable. Investment cycle will hurt profitability in the short term, but it will allow growth for many years to come. I believe that the news noise will eventually fade away and the stock will catch up with its strong fundamentals. Based on my discounted cash flow valuation, Baba stock is severely undervalued and it has an intrinsic value of $1,388 per share. That's it for today. I hope you enjoyed the video, and if you did, Please click the like and consider subscribing to the channel. And don't forget to comment with your opinion on investing in Alibaba and the Chinese market in general, or if you came with a different intrinsic value of Baba stock. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my view and is meant for entertainment only. Please do your own due diligence before investing in any instrument. Have a great day.